Hey, what is going on, guys? It is Brandon, the Fit Crypto, helping you make those crypto gains. Thank you so much for clicking on this video. Today, I'm going to be sharing with you guys kind of a unique perspective and take on the topic of undervalued cryptos and why there may be no such thing as an undervalued crypto and everyone may just be blowing hot air. Before I begin, though, just want to preface it by saying, not attacking anybody. Everyone has a right to say what they want to say, put videos on what they want to do. I don't care. That's not the point of this video. The point of this video is to give you guys an expanded awareness of this topic, teach you guys kind of the entire spectrum, give you guys the full picture of everything. And what I mean by an expanded awareness and full picture is the topic of duality. We live in a world of duality. Without diving too deep into any metaphysics or anything, we live in a world where there's hot and cold, there's up down, rich poor, left right, etc. You get my point. And you can't fully really understand this side of the spectrum without understanding this side, at least to a degree, right? You can't understand what hot is without knowing what cold is. You don't know what rich is without knowing what poor is, and so on and so forth. And in the same manner, you can't, if you're so focused right now on undervalued cryptos on this side of the spectrum, and you fail to realize that there's a completely other end of the spectrum, which is actually an financial investment theory that I'm going to dive into. If you fail to realize that there's this end of the spectrum and you're solely focused on this side, you're closing yourself off from all the information that is here, that is on this end of the spectrum, as well as in varying degrees within the spectrum. Okay, so the point of this video is to kind of open your awareness to both of the sides that exist and let you guys make your own decision as to where you want to fall, within the spectrum itself. Okay, guys. So with that being said, I'm going to dive into my computer and I'll see you guys in a second.
All right, guys, here we are. We're on Investopedia. If you guys don't know about Investopedia, then you should totally bookmark this. It's great. It's one of the OG resources if you're trying to learn about investing, concepts, fundamentals, all that good stuff. Yes, for the stock market. Anyways, guys, this is it. It's called the Efficient Market Hypothesis, the EMH, okay? And the definition here, I'm going to be like everyone else. I'm just going to read you guys this website because I don't have a lot of time to maybe do a PowerPoint or anything. So I'm just going to read you guys this. The efficient market hypothesis is an investment theory that states it is impossible to quote unquote beat the market because stock market efficiency causes existing share prices to always incorporate and reflect all relevant information. According to the EMH, stocks always trade at their fair value on stock exchanges, making it impossible for investors to either purchase undervalued stocks or sell stocks for inflated prices. As such, it should be impossible to outperform the overall market through expert stock selection or market timing. And the only way an investor can possibly obtain higher returns is by purchasing riskier investments, okay? So it's a cornerstone of modern financial theory. It's highly controversial and often disputed. Believers argue it is pointless to search for undervalued stocks or try to predict trends in the market through either fundamental or technical analysis. Maybe you guys know why I don't do technical analysis and I don't like price predictions. While academics point to a large body of evidence in support of EMH, an equal amount of dissension also exists. For example, investors such as Warren Buffett have consistently beaten the market over long periods of time, which by definition is impossible according to EMH. Detractors also point to events such as the 1987 stock market crash when the Dow fell by over 20% in a single day as evidence that stock prices can seriously deviate from their fair values. So what does this mean for investors? Proponents of the EMH conclude that because of the randomness of the market, investors could do better by investing in a low-cost passive portfolio. It's my cup of tea. Data compiled by Morningstar Inc. through its June 2015 active passive barometer study supports the conclusion. Morningstar compared active managers' returns in all categories against a composite made of related index funds and exchange-traded ETFs. The study found that year over year, only two groups of active managers successfully outperformed passive funds more than 50% of the time. These were U.S. small growth funds and diversified emerging market funds. In all of the other categories, including U.S. large blend, U.S. large value, and U.S. large growth, among others, investors would have fared better by investing in low-cost index funds or ETFs. While a percentage of active managers do outperform passive funds at some point, the challenge for investors is being able to identify which ones to do so. Less than 25% of the top performing active managers are able to consistently outperform their passive manager counterparts. Okay, that was a mouthful. Sorry, guys. I had to, I did what everyone else does. I just read you guys the website verbatim, but I didn't really feel like putting anything together to summarize this. So, but anyways, guys, this is it. This is the efficient market hypothesis. And it states that everything is valued as it should be because everything is taken into account. And as you guys can see, there's both sides of the equation. Some people disagree, some people agree with it. I'll share with you guys my opinion at the end of the video. But yeah, here it is. And I mean, it's basically, I mean, like I said, it's right here. It states there is data that says, if you have a passive portfolio, just let the market do its thing. You will probably, there's a good chance you will outperform people who are actively managing their portfolio or whatnot. Because it really comes down to the question of, okay, sure, are you really quote unquote beating the market, or are you really just getting lucky? Do you really have a method of beating the market, or are your picks just lucky enough that they happen to beat the market? I guess that's the question that this tries to answer, is that you can't really beat the market. If you do happen to quote unquote beat the market, you're really kind of just on the lucky end of the spectrum, is what it's saying. And you guys know my approach is very, very passive. I fall under the category of people who are passive investors. You guys know I'm not a trader. You guys know I don't do technical analysis. You guys know I don't try to predict anything in the short term. And this, like I said, this is a very interesting. It's just an interesting take and perspective on everything that you hear. You're always hearing this is undervalued. This is an undervalued crypto. Why Cardano is undervalued? Why Tron is undervalued? And honestly, I've watched a few of the videos, and the reasoning people give is they merely state what the coin is and what it does, and that hence is why it's undervalued. Most people don't back anything up with numbers or data, but like I said, they can do whatever they want to do. It doesn't matter to me. I'm just giving you guys kind of an opposite, like I said, perspective due to an actual investment theory. And here it is, the efficient market hypothesis. So you guys, I recommend just looking more into this, seeing what it's all about, seeing if it jives with what you think, and kind of go from there. But like I said, this was just to give you guys kind of that opposite perspective, so that way the opposite end of the spectrum, so you could understand the entire big picture and the entire spectrum a little bit more fully. Okay, so I'm gonna hop out of the computer and I'll finish up with you guys in a sec.
All right, guys, so there you have it. There was your breakdown of the efficient market hypothesis. Give you guys that, like I said, that awareness that there is another end to the spectrum on the topic of undervalued cryptos or undervalued assets. And just kind of open your mind up to the existence of that, and let you guys decide where you fall in between. Now, I do have to state that that theory, was it did come up, invented, if you will, for stocks and the stock market. And I have been told by numerous people that I don't know what I'm talking about, because the crypto markets are completely different than the stock markets. However, I would argue that they are financial markets nonetheless, so therefore fundamentals and principles of financial markets still apply to crypto or stocks, because it's a marketplace where value is exchanged. That's what I would argue. But you know what? What do I know? I may not know anything. There's so many experts nowadays that it's tough to keep track of everything. So you guys can always listen to me, or you don't want to listen to me. It's up to you. Sarcasm. But with that being said, guys, that was your efficient market hypothesis. I'll let you know where I stand on it. I err on the side of believing in that. I do believe that the market is efficient. The market takes into account all variables and situations, and thus the value of an asset is valued properly at that present point in time. And I just feel that a lot of people, when they say undervalued, they're really thinking just maybe a year from now. The value now is not what it should be a year from now. That's kind of what I'm gathering. And I mean, like I say, they can say whatever they want to say, I don't care. But in my opinion, I feel that at the current point in time, a value is always taken into consideration everything it knows, because if someone knows about it, they've made the decision to invest or not. The value reflects that. If a person doesn't know about it, they've obviously not invested. The value reflects that. The value reflects the fact that it's in a current stage in its development. When things progress, maybe real world use cases come in, thereby more value comes in to the project. The asset value reflects that, so on and so forth. So I'm of the opinion that I'm a believer in this hypothesis. I believe in the passive investing route. I really don't think that you can beat the market, and even if you can, I don't think it's worth the effort, time, resources that you would have to put in to beat it. I mean, you could, like I said, you guys know my thing, set it and forget it, right? Passive investing, that's what I'm all about. I'm all about the passive investing, the passive income, the minimizing your inputs to maximize your outputs. That's my perspective, and I just think if you let the market do its thing, you'll be better off in the long run in terms of how much effort you have to put in. But like I said, that's just my opinion. You guys can do whatever you want to do, think whatever you want to think. Let me know in the comments down below what you guys think of the efficient market hypothesis, what you think. Let me know about that. And with that being said, I'm going to wrap up this video, guys. As always, thank you so much for watching. I appreciate your support. I'll see you guys in the next video. Peace. Keep making those crypto gains.